Okay, let's talk to Craig Bolanos, the co-founder and wealth advisor at VestGen Wealth Partners. Craig, welcome to the show. How are you today?
Hey, I'm great, and I got to piggyback on that. That was one of the most intelligent statements I've heard from a political official in a long time. Well said, Governor.
Yes. I mean, it's low-hanging fruit, but if you're a politician and your team is in the playoffs, all you have to say that week is, go team. That's what people want to hear, right?
That's all anybody wants to hear, and people want to hear go market. I mean, and it's with tremendous reluctance that people have enthusiasm for 2026, but I think we're looking at a four-peat, John. 23, 24, 25 were superlative. I think 26 is going to be a decent follow-on act.
I've got one guy who says that the market's going to have a real rough time this year. Everybody else is saying double-digit gains.
You know, I think people are saying stocks are going to follow earnings. I think it might be tough with the PE for stocks to completely follow earnings, because earnings could easily be 12 to 14% higher this year. But that doesn't mean there's not room for growth. I'm just excited because so many listeners, John, have these well-diversified global multi-asset class portfolios. 2025 proved to be a benefactor of such. I think 2026 will be more of such. And the AI bubble, well, I get why people are making the comparisons, but we're not in a bubble.
Okay, I just want to read you what James Stack, the editor and publisher of InvestTech Research, said. He came on with us. Terry Savage invited him on. He's been on our show before. He was very bearish last year, and he didn't miss the market entirely because he was still 60-40, but he could have done better had he been more bullish. Anyway, he says today, as the political pressure increases on the Federal Reserve to more aggressively cut rates, the stakes on Wall Street have seldom been higher. With stock valuations at record levels, the downside risk, if a bear market strikes, could be extraordinarily painful. The simple reason is the biggest bear markets in Wall Street history always follow the periods of most extreme overvaluation. What's your reaction to that?
Everybody's acknowledged, you and I have talked, that there's tremendous asymmetrical risk in broad-based stock indices, especially given the concentration and the handful of names. No one's going to deny that. This is just a question of the timing of when, not the timing of if. I just don't think the timing of when is 2026.
So, well, look, it doesn't take a genius to say at some point the market's going to correct. And that's what we're talking about. But I think it's a very serious question about how things are going to do now, not because I'm a gambler, but because I want to retire someday, or I have retired, and I don't know if I should get very conservative with my money right now, or am I going to have another banner year? That's a really important question for a lot of people right now, Craig.
Well, John, I got to jump in. Let's answer it. You know, you read, quote, verbatim what that person said. The purpose of wealth, the purpose of money is to worry less and live more and pursue everything that you've worked your entire life for. So this shouldn't be about chasing performance, whether I should be 60-40 stocks to bonds, 80-20. This is about how much risk you're allowed to take in your portfolio and still get retired and stay retired. And John, for people who have already made it, what's wrong with continuing to reduce risk and stay in line with your risk budget so that you too can worry less? So what if you give up some of the gains? You got to be able to sleep at night. I thought that's what sleep at night portfolios were all about.
Right. So if today you say, okay, I'm going to do that, and then the market's up 12% at the end of the year, you have to remember this moment when you did not know what was going to happen, and at least you were able to sleep for 12 months.
Well, you know what? If I ended up 8% instead of up 12%, as long as 8% still solved for my financial plan, gave me the real returns that I need, I don't think you're apologizing to anybody. And I think what you're hinting to, but we should just speak to it, everyone who's listening, you're not an institution. Your time horizon on this earth is not infinite, it's finite. Don't invest like an institution. And because we're people, We are not an index. Let's quit comparing ourselves to a single index with massive concentration risk.
Yeah.
Let's start comparing ourselves to the multiple indices that we are, because life in retirement is not a straight line. It's a curve. But, John, you said something. These attacks on Fed independence, oh, boy, they're very, very real. And I think all of this is just raising the stakes for whoever that next Federal Reserve chairperson is.
Well, I want to talk to you about that, too. Craig Bolanos is on the line, the co-founder and wealth advisor at VestGen Wealth Partners. The website is getretiredstayretired.com. All right, we'll pick it up here in a minute. We're talking to Craig Bolanos on the Noon Business Lunch. He's the co-founder and wealth advisor at VestGen Wealth Partners. Getretiredstayretired.com. Craig, you mentioned just before the break something about the Fed chair and the squabble about that. What are your thoughts right now?
Well, I mean, none of it's been good. And I think all of this, as I mentioned, John, just raises the stake on the new Fed chair once we get one. I mean, if that Fed isn't viewed as independent, then the global bond market's going to punish us. It's going to increase rates, run a respark of inflation. And I think President Trump knows that. Maybe that's the reason he just said a couple hours ago, hey, I'm going to leave Hassett right where he is in my administration and not have him be a part of the Fed. I think the other big story is typically when the Fed chairs get reappointed, they retire thereafter. I mean, one of the things Wall Street's struggling with is Jerome Powell actually going to stay on at the FOMC and act as what I call a pseudo-Fed chair, to counteract whoever gets appointed. So all of this is drama like a soap opera, and I don't think any of it's good for bond markets, and we don't want to see Treasury yields blow out again.
I would like to see him stay on just because if he retires from the board after his chairmanship ends in the spring, then Trump gets another appointee, and I don't want him sandbagging that board. I know little about the Fed, but I know it needs to be independent. And if he gets all of these yes men on there, then we lose that independence that you're talking about, right?
Yeah, I mean, America is the world's bank. I mean, when there's times of crisis, Putin goes into Ukraine, money flows into America. Hamas into Israel, money flows into America. Bad things happen wherever they are around the globe. Money always finds its way into dollar-denominated assets. We don't want to do anything to jeopardize that long term, and any of this that undermines credibility and independence exactly as that it could. So fingers crossed that free markets and prevailing themes win at the end.
I suppose the proof will be in the pudding. Whoever gets that job, then, it will just depend on what they say or how they vote. What do we do with those rates? And I wonder if a half a point reduction would be a signal to the market that's good. Hooray, stocks will jump if the rate goes down a half a point, or will we suffer because it'll look, again, like a political statement and not an economic one?
Well, that's right. You want to make sure you don't have this competing interest where all the other voting members of the Fed, depending on who the chair is, end up voting or posturing or having that perception, because the perception is as important as the reality. I say that again, the perception is as important as the reality. But, John, let's not mistake that we've had 6 weeks of almost Goldilocks financial data, right? Solid growth, lower inflation. You can't deny that people's tax refunds, tax returns are going to look good courtesy of the One Big Beautiful Bill Act. So I think the bottom line here is the fundamentals are positive, but we all acknowledge the forces pressuring them are rising and will continue to do so throughout the year.
You advising your clients to rotate into something outside of the Magnificent Seven?
We've been big fans of expressing to everybody that the AI enthusiasm trade is also about non-technology companies and their ability to benefit in terms of productivity. So I think everyone needs to take a real look under the hood of what they own, because I'm worried, John, that there are people that are 45 to 70% all in technology and communications. I'm sorry, I don't think that's a durable portfolio for decades to come. I think people need to embrace multiple sectors, pay attention to valuation, and just know that as this market continues to climb higher, your rebalancing protocols are more important than ever.
Are you paying attention to oil prices?
Well, I think everyone pays attention to all prices because for as green as anybody wants to be, oil has mattered. Oil's going to continue to matter. And certainly the actions we took with Venezuela points to the fact that having command and control of West Texas Intermediate crude oil does matter. So commodity prices obviously have been a very, very big story. But when I've got oil trading at what, $59, $60 a barrel, John, you remember when oil was at zero during the pandemic? How crazy was that? And remember when it was 120, 20 years ago? I feel right at home at $60 a barrel.
Wonder to what degree our adventures in the Caribbean are going to affect those prices, or Iran for that matter. I mean, that's going to be a factor, right?
Oh, I mean, the Iranian thing's a big factor. Markets calmed down yesterday when some of those headlines broke that there wasn't going to be more mass executions and killings, hopefully, taking some, I don't know, possible intervention by us in the United States. But I do think, you mentioned oil. I'm going to call it commodities. I'm going to call it precious metals. I think investing for a real return has merit. And I think there's a lot of people that when they talk about rebalancing their portfolios, it shouldn't just be a stock and bond thing. When I say multiple asset classes, it's a stock, bond, precious metal, storage of value, commodity thing. I think that's some of what people should start deploying if they haven't as we go further into 2026 and 2027.
At $60 a barrel, do you think there's an upside to oil right now? Would that be a smart place?
I think there's an upside to energy stocks because the world remains underpowered. One of the single largest prohibitive dilemmas that other countries have, not in the United States. I mean, there's a reason we have more data centers in America than the next 10 countries combined. It's those other countries don't have command and control over their energy policy. So I think energy is an enduring theme, an important theme, and whether it's energy stocks, whether it's the underlying commodities, I think there's room for that in lots of people's portfolios.
Craig Bolanos is the co-founder and wealth advisor at VestGen Wealth Partners. GetRetired, StayRetired.com is his website. Okay, Craig, always a pleasure to talk to you. Thank you.